welcome everybody. This presentation today is an opportunity to update investors on what's been a busy but very challenging 6 months, and to give investors an update on some of the changes post the divestment of the energy management business earlier in the year, and some of the implementations that we've invested in order to secure a strong and productive scalable business. So as I said, has been a challenging first half. I think there are a number of things I'd like to just surface before we go into the sort of trading update generally. As a macro environment, we've suffered a little bit of ESG fatigue over the last 12 months following what was a frenetic energy crisis in 2022. This was exacerbated, I would say, by two things. Firstly, the rise in interest rates and the stabilization and coming off the peak and reducing energy prices. So it created a slight perfect storm for businesses like ours in our sector, globally, I might add, where there'd been a lot of activity around energy transition and then a tailing off where businesses were investing internally on their own, if you like, stabilization strategies. I have to say that I think that time has passed and that we're now in a period of strong recovery as a market. But I wanted to just set the scene to say that we were not alone in the market, in the sense that there was slowing down of energy transition projects in our sector. I think the disruption during and post divestment of the energy management division was significant for our business. We're a small business and we were divesting over half of our operating model. And with that came some challenges as we decoupled that business to enable a seamless transition. And I think overall our slightly weaker than expected first half of the year masks what has been significant and substantial progress across the business. As part of the divestment, we have taken the opportunity to restructure our operating model within energy services and taken the opportunity to pause and reset to allow ourselves to build a really strong foundation for growth. And there was really only one opportunity to do that, and we seized the opportunity to do that in Q2. And I think that we are now going to see the benefits of that as we move forward. So we've invested in upgrading our management team, and particularly the renewables division. We hired a new COO, Nick Clark, who I've known for some time and who we've built a strong operating strategy around. And we've also invested in technology, which we'll talk about shortly. Combined to that, we've had the support and the benefits now of our strengthened balance sheet as we've renegotiated supply chain across our various divisions in the business. And we've seen the first few drawdowns of the NatWest facility bed down, and that now allows us to move at pace with that funding facility. We've seen a strong recovery in the first few months of this period, and I think that is in relation to a government change, in relation to a refocus of the public sector on their net zero strategies, and in the first few months of the year we've seen a record pipeline growth in terms of origination of new projects to assessment, and so we're expecting that to now flow through into the second half of the year. But most importantly is the fact that we've got visibility and sight of the majority of our required contracted revenues in order to deliver our H2 number, and we're maintaining our full year guidance. Wrapped around that is confidence in our margins, and in some cases an upward trend in those margins, which we can talk about a little bit later. So a very busy and challenging period, lots of investment, huge, I guess, confidence in our platform now, and a really strong pipeline. So if we just move to the next slide. For those investors that have joined today that haven't been part of the previous strategic sort of, if you like, proposition, we've now simplified our services offering into 3 pillars of service, all of which have the same philosophy, which is end-to-end turnkey solutions delivered capital-free for our customers with an off-balance sheet solution, with our proprietary funding platform, and with a data wrap around measurement verification and visibility of energy data. So when we think about energy reduction, we're in the main talking about energy efficiency, investment in lighting and controls, where we're able to use our proprietary technology and our eEnergy app to deliver rapid investment-grade proposals to our customers at scale, maintaining a high and strong gross margin of 38%, which has the potential to trend upwards as we've now started to see some margin improvements around supply chain and funding facilities. So reduction, core stability of our business is where the heritage come from. We've done over 1,000 projects now, and we expect to deliver somewhere between 250 and 300 energy efficiency reduction projects in this calendar year. Generation, this refers to turnkey solar PV solutions and includes ground mount, rooftop, and carport solutions. We focus on risk-managed, quality, high-service solutions. We don't sell on price. We're very much focused at the quality end of the market. Gross margins slightly lower, but the money margins tend to be generally higher because the projects are generally larger. And then charging, which is a peripheral service line at the moment, but one which we see growing. So the EV adoption and charging infrastructure market has had a bit of a bumpy ride over the last 18 months, largely because the take-up has been a little bit sporadic. And I think that most customers are wanting to dip their toe in the water when they think about charging solutions. So we tend to see this as a additional service to either reduction or generation services, but one which we see going to scale in the future. Go to the next slide, please. So let's think about our market. There are a number of very strong drivers. I think the ones which are worth focusing on right now are the fact that we've, under a new government, got a much more accelerated and focused strategy around net zero. I think the previous government was fatigued around what they were doing, didn't have the energy and the impetus that was desperately needed within particularly the public sector. We're seeing already quite favourable red tape restrictions being lifted, and I think that is helping decision makers get to a project decision quite quickly now, whereas it used to take 6 to 12 months with huge amounts of, red tape around the compliance of procurement. So invigorated energy, thinking about a race to net zero. We've got 6 years from which to achieve some very ambitious goals in the public sector, and I think that has really come to the forefront of the public sector. So we see that as being a really major pivot for growth acceleration. I think whilst the government is looking to increase grants in some areas, there is a scarcity of capital generally across both commercial and public sector. And I think that the ability to be able to provide turnkey capital-free solutions is a real enabler now as we think about adopting energy as a service for decarbonisation solutions. Another driver for us is the fact we've solidified a really strong brand, particularly in the public sector, where companies, I think, have a lot of execution, or rather our customers have a lot of execution risk when they think about different schemes. So to have a provider that can do a turnkey solution, build a relationship, and stagger different initiatives through different transition projects, from energy reduction to generation to charging, and in the future for energy storage, we think is one of our key attributes. Solar is clearly driving the majority of our growth aspirations. It's a hugely addressable market. There is very favourable economics, whether you're investing in yourself or whether you're doing a funded solution. The numbers all work very, very well and very positively to develop solar solutions for rooftop schemes or ground mount schemes. A volatile energy market is always good for the energy transition space. And I think the reason I say that is because what solar does is it provides stability and security of supply. So if you think around a third of the energy consumption of our customers can be de-risked by coming off grid, it's effectively locking in a price for 10 years on that third that was previously purchased by the grid that's now going to be purchased via rooftop or ground mount solar. So just touching on the size of our addressable market, we commissioned our own independent research because we were keen to understand the data points around adoption, addressable market for both education, healthcare, and other parts of the public sector. And we were very pleasantly surprised. And this report that we commissioned was also validated by one of our third-party partners who also commissioned a similar report, which were kind enough to share with us. And we can see 65% remaining addressable market in education for energy efficiency lighting solutions. That in itself is a £2 billion opportunity for us. And this is not a 3 or 4 year window. This is a decade opportunity. Yes, we believe that the next few years are going to be accelerated, but the long tail we have every reason to believe will last for many years to come past the 2030 deadline. In NHS, there is still 50% of the built infrastructure still with old fluorescent lighting and incandescent lighting. This is under a mandate to transition fast, not only because fluorescents have now been banned, but also because of the drive for lower cost, more efficient, highly compliant, more suitable lighting solutions. So the addressable market for us is very, very strong. But what is also important is that the competitive landscape is also very favorable for us now that we've established a significant size in the market. So given that we don't focusing on the SME market, which is low barrier to entry, race to low margins, any electrical contractor can procure hardware from the distributors or from the wholesalers and use their own labor to install solar or EV charging for small scale SME solutions of 10 to 50,000. We're very much in the high quality, high service, £250 to £5 million project size. And for projects like that, our customers want track record, they want credibility, they want businesses with a strong balance sheet, and they want so many of these sort of compliant, if you like, boxes ticked, which the smaller, low barrier to entry service providers can't offer. So we see this as being a good barrier to entry for our own proposition, and we see this as also an enabler for rapid growth. So when I think about the transition highlights, just touching on some of the things we've done in specific terms, we built a scalable operating model. We have two parts of our business. We have a development platform, which is responsible for originating opportunities, assessing, qualifying, and generating an investment grade solution, an investment grade proposition in the form of an investment grade proposal for the customer. That takes time, it takes resource, it takes data, and it takes knowledge and skill sets. In order for a developer to be scalable, profitable, and work at a high margin and to operate at a leadership position in the market, that process has to be automated, it has to be systemized, and it has to use technology. And we've invested quite heavily in our own proprietary app to enhance that automation. And within that whole development model, we've also invested in our operations and CRM platform. On the contracting side, which is the EPC part of our business, that stands for engineering, procurement, and contracting construction. We're very much around optimizing margins and making our process efficient in order that our project margins can be controlled from a QS perspective, delivered on time at a high quality service. So we've invested in our management team, we've upscaled our technical solutions team, and in particular to facilitate the rapid growth from solar this time last year, which we're talking about a 500% organic year-on-year growth. We've had to set ourselves up for scale in the future. So we've been very thoughtful about what are the drivers, what are the barriers to entry, and what are the differentiations in our operating model outside of our proposition that can make this a really high scale, highly valuable and sustainable growth business. As part and parcel of that whole group structure, we've also fully integrated and invested in our finance ERP system, which is integrated within our operations CRM platform as well. Crispin can talk a bit about the investment we've made there, but it's been a significant investment and one which I think will stand us in good stead for the future. Obviously, the disposal of our division has transformed our balance sheet. We've previously updated investors on the phenomenal facility we have in NatWest, and that relationship's going from strength to strength. And then in the background, while all of this has been going on, as I mentioned, the market has gone through a period of recovery, and we believe we've seen the recovery represent our strongest 2 quarters of new opportunities coming through to investment proposal stage, which we think will now start giving us the momentum for H2 and beyond next year. I'll pass you over to Crispin for the next couple of slides, and then I'll come back to the outlook and the future growth drivers.
Thanks, Harvey. So as Harvey has outlined, the H1 results were challenging. These were impacted by a constrained balance sheet prior to the completion of the sale of the energy management division during Q1, and also a challenging market condition as a result of a reduction in energy prices at the same time as an increase in the cost of finance. The core revenue for the energy services business of 6.2 million was therefore down from 11 million on a like-for-like basis in the previous year, with an adjusted EBITDA loss of 2.1 million for the group, down from a profit of £500,000 on a like-for-like basis. The operating cash flow for the period reflects this, with strong cash generation expected in H2, mirroring the forecast earnings profile for the year. Following the disposal of energy management, we have taken the opportunity to conduct a full review of the group's balance sheet. Following this review, we are expecting to take an exceptional charge of up to 2.5 million at the half year, and further detail on this will be provided in the interim accounts. As Harvey's mentioned, we've been pleased to see a strengthening in the market during the period, and the political certainty given to decision makers following the UK elections has further supported this. The business has strong momentum coming into H1, and the board is maintaining full year revenue guidance. Thank you. So the H2 forecast is underpinned by a robust contracted forward order book coming into the period, which covers 44% of forecast H2 LED revenues as at the date of the trading update. And that's consistent with our target to maintain at least a 3-month contracted forward order book. 75% of the forecast H2 solar revenues were also contracted. And as you'd expect, contracted revenues have further increased in the last few weeks since the trading update. We have good coverage on the new business requirement for H2, following the record pipeline growth in H1 Harvey's already mentioned. And I'm pleased to say that the management actions during H1 are delivering improving margins for both LED and solar. We expect this trend to continue through H2 and beyond. Whilst the H2 revenue forecast represents a step up from H1, the robust forward order book and strong pipeline allows the board to maintain the full year revenue guidance at 25 to 26 million. Thanks, Harvey.
Thanks. So just to wrap up, as we think about moving forward, yes, it looks like a big stretch that we're going from 6 million in H1 to 19 million in H2, and the cynic would say, is that possible? Is that deliverable? I believe it is. I'm feeling very confident that it is. Clearly, we've got timing issues around end of the year, but we've been meticulous in our planning, and as Crispin said, we've got plenty of coverage in our pipeline for the small slice of revenues we don't yet have covered, but the majority of which we do. So I think I'm focused on making sure our operations team deliver a high quality solution with Nick around the contracts we've got already locked in. I think as I look outside of H2, I'm thinking very much about how do we achieve strong growth year on year going forward. I'm excited about this race to 2030. I like the fact we've got a leadership position in the public sector now. I think healthcare is going to play a major part in our strategy going forward. And I think the one thing that probably we haven't touched on in the presentation yet is year to date on our journey on AIM, we've been very much a direct sales business. We've originated our projects directly with our customers. We've taken them through to investment grade proposal, and we've had a very strong 50% conversion rate. Our competitors have all done it very differently. They've all driven their growth, almost without exception, through the framework structure and through channel partnership, referral channel deals. We've, in the last 6 months, invested very, very heavily around a framework strategy. And we expect now to be in a position where we can compete head to head within frameworks. We've already onboarded, I think somewhere in the region of 8 to 9 frameworks where we are going head to head with all of our other competitors. And we believe that that layering on top of the extremely successful direct sales channel is going to give us the pivot for significant growth going forward. Partly enables us to go after the 7-8 figure deals. It's also partly allows us to pivot into healthcare more rapidly. It's taken us a long time to, I guess, be compliant and to be in a position where we have the right to win these larger projects. And I think the securing of the Spire contract, which is going well, incidentally, has been part of that journey. So super excited about what we can deliver in healthcare, particularly after such a strong few months of delivery around the healthcare sector which we're operating with Spire. So we've got a strong platform, we've got a strong delivery ethos, we're focused on quality and service, and we are well positioned, unlike our competitors, in being able to offer third-party financing solutions in a very slick and compliant way. It's not simply a case of arranging asset financing. That doesn't work within the public sector. We've spent years perfecting a slick and seamless off-balance sheet solution that navigates through procurement, compliance, legal and accounting hurdles. And I think that combined with our proprietary technology on getting investment grade proposals fast to customers without the need to hire lots more people is going to be the inflection point for our growth going forward. So yeah, sitting here, excited about the future, looking forward to getting back in touch in September to talk about our interims.
Okay. What do the existing trials that you mentioned earlier look like? Are they predominantly in solar or lighting, and how do you expect those to transition?
Not sure I understand the question. When you say trials,
Well, I think when you talked previously about, when you win a contract, they probably will have been in a trial prior to winning that contract.
Oh, I see. Okay, fine. So in education, there's two parts to that answer. So in education, what we tend to see is a long tail of customers with many numerous projects under their portfolios. A year ago, a large multi-site 20-school trust would probably have wanted our organisation to do 1 or 2 trials first before they award a significant multi-site contract. What we're finding actually is that it's no longer the case. Based on the credentials and historic delivery capabilities we've had, we're going straight to award of multi-site contracts. We're not announcing those into the market because they're within our day-to-day business wins, and they don't feature more than, I think, 5 or 10% of the revenue number. I think there's a trigger that Spire triggered, which these other contracts, which are anything between 500 and £1 million, don't trigger. But in the background, what we're seeing is an increase of our average order value, successful winning of much larger projects without having to go through trial. That said, on solar, some do want us to do 1 or 2 projects first before they start thinking about other rollouts. Less so than it used to be. But I don't think we have, what we certainly don't have, and I think this might answer the question, what we don't have is a situation where we do a trial and don't get the next prize. So if we do enter a trial, 9 times out of 10, if not more than that, we get the full rollout afterwards.
Understood. Thank you. In terms of the disposal of the EM division, has there been a tangible shift in the mindset of the team post that disposal? And one assumes they're feeling pretty optimistic about the outlook.
Yeah, so being completely transparent, it was a tough transition from a cultural team building perspective. We'd spent 3 years building a strong team, an integrated team, obviously getting rid of half the business in a fairly tight 6, sort of, if you like, period. is challenging for a business of our size. We were fortunate enough to have the business located largely in Coventry, so we were fortunate enough to sort of see it physically in one location, exit the business, but we still have, you know, a number of people that work out of our London offices. I would say that morale has certainly never been higher in our business than it is today. We've had the opportunity to hire a group of new both technical and senior leadership people in the business that have helped accelerate that morale. I think we did lose a few people on the way. I think that's inevitable. And I think as a result of that change, we've been able to solidify a new culture and a new sense of purpose with our strategy. So was disruptive for about a 3-month period. And I think by the time we got to June of this year, I feel that was settling down quite nicely. And I feel pretty content now. We've got a really strong, really strong morale in the business. We've got a new chief people officer who has done a huge amount of work with our leadership training, performance coaching platform as well with our people, and that's starting to pay dividends as well.
Thank you. That probably leads quite nicely on to why is the role of COO been created, and can you give us some background on Nick Clark, please?
Yeah, it's a good question. So I worked with Nick 12 years ago when I was an investor in a lighting efficiency business. Nick then actually was part of the initial sort of setup team of eEnergy when we started in 2014, but weren't quite big enough to sustain such a heavy hitter. So Nick went on to run Sylvania, which is a big lighting manufacturing business, and then more latterly Aurora. So he comes from a projects background, commercially focused individual, strong leadership. And I think what I was looking for was someone who could be very project focused, someone who was very much process focused around optimizing our projects business. And as I say, we have a development business and we have a contracting EPC business. And it's very easy for businesses like us to have leaky project margins. So you end up not getting the margin that you expect on a project because the controls aren't there, because the processes aren't there. So previously we had an MD of energy services and we had an MD of energy management. With this new structure, there was a very much clear gap in our operational, if you like, requirements. But that operational gap needs much more than just hands-on operations. We're an integrated developing business that develops projects, and that has operational capacity. So I needed someone who had commercial skills and awareness of projects, but also who was a good team leader and someone that I had a relationship with. So that's the sort of background. Nick's been with us really in a part-time capacity for 6 months, but full-time now for 3 months.
Thank you. Let's have a look. So obviously there are a few questions around the 40 million facility. Are you exploring a similar facility for private sector customers? Would that work? Is it applicable?
It's a brilliant question. I like that one. So absolutely yes, because I see that the growth in solar will not just be limited to the public sector. On the flip side, we won't be pursuing strong project growth in the commercial sector for lighting, but we will be pursuing very strong project growth in commercial industrial. And this year, when we think about our 11-12 million of revenue that we'll get from solar, possibly more than that, I suspect 70-80% of that this year will come from commercial industrial projects, okay? Because it just so happened that they were Inspire's a commercial project, even though it's healthcare. And so as part of that, we have been working very closely with a very important strategic partner, which I'm hoping to start talking about in the coming weeks and months, who has just funded our first deal in the private space, who's a big international player, has perfected the energy as a service business model in America. And we've been forming close relationships with both from can we create a product that services the funding needs of commercial industrial projects, but also can we be a reciprocal development partner and delivery partner for them in the European markets. So yes, it's definitely on my radar to secure something similar to what NatWest have got for the public sector, because I think then we've got a full house in terms of funding propositions.
And for the uninitiated that are maybe joining this call, can you, if possible, give a brief overview as to how that facility benefits the consumer or the customer, shall we say?
Yeah, look, at a super high level, what we do not sell is asset financing for third-party technical products, right? What we do is we wrap up a service solution in the form of a monthly or quarterly service payment that the customer pays, which is used to pay, is paid rather from the savings we unlock from the projects we invest in. So if we end up identifying that a particular customer, for example, can save £100,000 a year from upgrading their lighting infrastructure, the monthly payments might total £70,000 in the year, and they'll be left with a 30,000 surplus. So what we always do is design capital-free, cash flow positive solutions for the customer, where from day one, month one, they're unlocking carbon and being cash flow positive in their P&L, and it's structured as a service agreement with performance obligations and with the ability to monitor and track savings at the same time.
Okay, thank you. You mentioned the charging division earlier in the presentation and said that at present it's almost an add-on service when you have additional contracts. I mean, do you see a point where that will change? What time frame?
Possibly. I think the charging space is in two parts. You've got your rapid chargers, which are £50,000 to £100,000 expensive units sitting on service junctions, like at petrol stations or McDonald's, or in hotel junctions on the motorway intersections. These are 10-minute chargers for people who are on the move. Then you've got the AC units, which are anywhere between sort of 3 and 7 hours to charge your car, which are workplace charging, which are 5 to 10 grand a unit versus 50 to 100 grand a unit. So the market is very, very bipolar in terms of you've got these two extremes. On the rapid charging, you've got a utilization model where the people who are investing in those chargers are taking utilization risk. So they're putting in effectively a toll bridge, they're paying for that up front, hoping that the chargers will be used. That is a particular infrastructure type of investor that's needed for that. So take Instavolt, for example, which is one of the UK's leading kind of hub developers for rapids. They've invested hundreds of millions of pounds into chargers over the last 7-8 years. The majority of the market, however, is AC, which is expensive plugs, essentially on tap for people wanting to park 3 to 7 hours, okay, or overnight. Now, that market is confused because you've got landlords not really wanting to invest huge amounts of capital into their infrastructure on behalf of tenants because they don't get a return from it. And you've got tenants who are trying to figure out whether they're charging their staff and are they monetizing their customers for charging, or is it simply a service? Either way, it's not a cash generation energy transition. It's an infrastructure. It's a necessity. So landlords are all caught in this crossfire of, I've got to do it, but when do I do it? The uptake has been slower for chargers than I think a lot of people anticipated, because a lot of people who own a car are charging at home at night. So it's a very confused market, and the margins are not particularly strong. Your 20-25% margin, because your average electrician can install a plug for an EV, right? It's pretty simple. It's not complex. Where we were finding our customers having a challenge was, you take a school that have got 200 teachers, and a lot of these big independent schools or secondary schools have got 50 to 200 teachers. To put in 10 chargers, it's suddenly £100,000 investment. So what they were finding is maybe only 2 or 3 teachers turned up this year with an electric vehicle, and they only need a couple. So we were doing very elaborate and expensive infrastructure upgrade proposals, hitting with anywhere between £100,000 and £500,000 proposal value. It not being cash generative because it was an infrastructure investment, and the client turning around saying, I'll take 3 or I'll take 4, and it being a £15,000 £3,000 margin reward for us. That time and investment was so much better spent on £1 million solar project. It's going to drop £250,000 profit for us. So what I'm trying to encourage our commercial team to do is always include 2 chargers on a proposal. Let's get our customers on board with a proposal with a couple of chargers, get them using it. And then we've got a foot in the door for when they do want 5, 10, 15, 20. But I think it would be quite dangerous for us to have a customer acquisition strategy solely focused around charging right now. And I don't think investors have got the appetite for us as a business as much as we could to start owning a bunch of rapids in hospitals and education facilities, which may or may not deliver an 8, 9, 10, 11% IRR on their investment. And I don't think that's the business we're in at the moment when we've got so much other exciting, really profitable business to go and win.
Yeah. And I suppose a follow-on question from that, which I think you've probably already answered, around acquisitions. Obviously, the balance sheet is in very good shape now. Do you foresee making acquisitions, and in what area will that be? I'm sure you're getting asked that question lots now. I'm assuming it won't be in charging, but
there's a slightly flippant response to that. Is if our investors get behind us and ramp our share price to 24p, we'll be doing tons of acquisitions that will be earnings enhancing. Now, it's a shame because being on AIM means really we should be thinking about M&A, and that's the reason. Really, is this one of the sole reasons to be on AIM, okay, which is to have the ability to utilize your cap structure in such a way that you can have earnings enhancing acquisitions quite quickly. Now, there are lots of interesting acquisition opportunities out there that we could and probably should be doing, but we're not going to be doing until we've got ourselves established as a strong growth, high margin, cash generative business. I would like to be doing both. I've turned around and said to our team, we're putting M&A on hold. And I've also turned away lots of interesting acquisition opportunities because I don't think we should be taking that risk at this point in time. But the moment I think our share price reflects true value, which could be anytime soon, I hope, then yes, I think I could convince a lot of interesting vendors to take paper in our stock, and we could have a more vertically integrated M&A story around solar and thinking about different service propositions that could bolt onto what we're doing without there being any distractions. But yeah, we'll see.
All in good time. So carrying on with the balance sheet, obviously the balance sheet was constrained before. Can you give more detail on which areas you will now be prioritising for increases in working capital?
So we've worked really hard on our supply chain, and to do that we had to settle and we had to hit our supply chain quite hard with where we were able to service them and where we weren't able to service them. I think having a strong balance sheet has enabled us to negotiate better terms and stretch out our available credit ecosystem, which really means that we can do more projects without having to fund them all ourselves in the construction cycle. But that's the point with solar, which is why there is such a big barrier to entry for certainly startups and certainly small businesses trying to get to our scale now on project size, is that if you sign a £5 million solar project, you're looking at probably £2.5 million worth of hardware, £2 to £2.5 million worth of hardware that needs to be purchased, right? If you haven't got a strong balance sheet, you're not going to get the right terms. And if you haven't got the right terms, you're going to have to front up that capital yourself. We're having a trade-off. We're playing both against each other. So we've got good terms coming from when we do use credit, and also good terms when we use our own construction, if you like, advance on supply chain. So having the working capital to be able to allow the cycle of cash generation to work itself through on a solar project is super important. I mean, to put it in context, you probably need a year's worth of working capital to run a solar business. That would be my view, and we were probably thinking we could do that on 1 or 2 months working capital, which was clearly why I think we came to the conclusion we needed to pick one of our 2 strategic channels, and that's why we chose energy services, because of its high growth potential. So I think really it's more of a function of what does it allow us to do and use rather than deploy the capital for long-term investment. Yes, we've made a few bets around technology, but we're not talking about millions of pounds here. We're talking about you know, 200,000 or 300,000 worth of investment in our app and in some other infrastructure areas. Yeah, it all adds up, but it's going to be for the long-term growth of the business, and it was the right thing to do. But we're not investing in assets, we're not investing in acquisitions, and we're not investing in upfront speculation on projects. We're really investing in technology, process and systemization, and using our strong balance sheet to enable us to work in the way we need to work to generate the big margins from big projects.
And I know it's very much at the forefront of everyone's mind at the moment. Have you had a look at AI, or could AI play a part in the data within your business?
Without question, anyone in any business, in any sector that is not taking AI seriously is going to get left behind. That's fundamentally my philosophy. In the energy markets, there is the opportunity. AI is about learning from data, and it's about how do you leverage the learning automatically to avoid you having to go through costly manual processes. If we're assessing and auditing hundreds of sites a month, AI should be able to learn from what we're seeing and what we're doing to get us to where we want to get to faster. AI should be able to help us in our development cycle with our customer origination strategies. AI should be able to help us in monitoring, verifying data from projects to help second guess other forms of opportunities. So look, we haven't quite had the time to properly consider AI, but it's not on our radar. And I really hope that in 6 months' time, I can find myself immersing the opportunity of AI into our business to look for some low-hanging fruit for what we could do.
And I guess AI is all about data in, isn't it? And it sounds as though you've invested in the technology, which will presumably help you bring in that data.
Yeah. We have a data mindset, data philosophy for what is effectively quite a hands-on business model. And I think that will be the thing that separates us from the pack in the next 2 or 3 years.
Yeah, great. Thank you. Let's have a look. How is the relationship with Luseco developing since it became
Luseco
since it became a large shareholder?
Tricky name.
Yes.
Great partner, great relationship. Fantastic product, fantastic company. We love having them as a partner. They've been super supportive. We think they're great, and they're giving us a real edge on the market, going from strength to strength.
Great, good to hear. And finally, you cite energy prices and rising cost of capital as previously being a drag on the business. Interest rates, hopefully, on the downward trend now. Can you explain why you're more optimistic on energy prices?
Well, I'm not sure I'm optimistic on energy prices. I think what I said is I'm optimistic on the growth potential. I think I got to learn a lot about the energy markets with Delvin, who was running our previous business. And it was a fascinating journey for 3 years, or 2.5, 3 years. What I took away from that is that customers and the market, a little bit like I suspect a stockbroker might prefer, is there's a trend of following behavior. So when we were going through a period of escalation of prices, people were in panic, and there was a lot of denial about, is it going to keep on going? Is it going to keep on going? I'll be able to buy cheaper next month, and everyone left it to the very last day of their buying cycle and got caught out. Then we were in a period of it peaked, and everyone held off because they think it's going to come back to where it used to be. I think my research, which is from a wide variety of sources, tells me a couple of things. It tells me that I think there is a lot of non-commodity costs of energy, that there is no uncertainty that that is going to rise. Cost of carbon, cost of infrastructure upgrades, cost of grid upgrades. Anyone in their right mind, if they did any research around that area, would recognize that someone's got to pay to get the energy transported from old single distribution points to microgrid communities, private wires. That's being reflected and will have to be reflected for the next decade in everyone's energy prices. So even if commodity costs come down for oil, right, and therefore then for gas, and therefore then for power as we know it, the non-commodity costs will certainly not ever allow it to go back to the very low points of the single-digit per kilowatt prices we had. So I think personal view is it's probably flattish in terms of mid to long term curve, but the cost of carbon tax is going to start roofing, and the world could be in for a monumental carbon tax shakeout. I've got some macro hedge fund partners from a long time now that talk to me a lot about carbon tax and about the global carbon tax problem we have, and who's going to end up paying for it? The consumer. So I just think personally that we're in for a flat market generally for power prices, but that what we'll end up with is people looking for more certainty on security of their supply, because we'll start to have a much more fragile grid. And we've already seen, I don't know whether other people have seen it, but I've certainly noticed it, and my clients noticed it, way more power outages, way more problems with the grid connections, way more problems with DNO connections and things like that at the grid level. So
yeah, and you alluded to feeling a little bit more optimistic given the new government, and do you think that will overspill into infrastructure? I mean, obviously that has spend implications, but in terms of the rollout of that much needed infrastructure?
I think the infrastructure is going to be paid for by the private commercial space. I think the government's got enough on its hands right now, and I think what they'll be doing is letting the problem be easier to solve by the likes of commercial private companies. Grid infrastructure upgrades, you know, I'm not sure. I think that's probably not on the top three things the government's thinking about right now. I think they're thinking about hospitals leaking energy. You know, 50% of hospitals and education facilities leak energy. 50% is wasted energy. If they can stop that, they've solved a £1 billion problem.
Yeah, makes total sense. Great, well, that's quite an impressive note to end on. Any questions that we should be asking you and that I haven't asked you?
I think there's been quite a lot of questions there. So yeah, I think tune in for September, and hopefully we'll start cementing some really positive growth stories around what we're doing.
Excellent. Well, thanks very much for that, Harvey. Thank you, Crispin. Thank you to everyone that joined. Just for your information, we'll send out an email. If you could reply and just give the company some feedback on this presentation, that would be most helpful. And like Harvey said, interims in September. Sorry, next update is the interim September.